Welcome back to this week's edition of the Risk Spotlight Operational Risk News Update. My name is Emily Jones, and today I'll bring you essential updates and insights from the world of operational risk. All information is sourced from the RiskSpotlight Portal, the premier forward-looking service for operational risk content. Let's get started. First up, let's have a look at some eye-opening cyber risk data for the financial services sector. According to the Modern Bank Heist Report 2025 from Contrast Security, over half, 54%, of global financial institutions experienced cyberattacks last year in which adversaries destroyed data. This represents a 12.5% rise on 2023 figures. However, the report indicates that destructive attacks in financial services are more about hiding traces of wrongdoing than simply damaging systems. Threat actors often encrypt files, delete data, or destroy hard drives to cover their tracks. Overall, the report found two-thirds of respondents, 64%, had experienced cyber incidents over the past year. Although 94% claimed they were able to detect and respond effectively, the study still identified 46 impactful attacks per month that bypassed web application firewalls. The financial industry continues to be an attractive target for adversaries, with cloud environments and APIs singled out as especially exposed. A majority of respondents, 71%, cited zero-day threats to apps and APIs as their top concern. Attackers aren't only looking to wipe data, they also aim to steal and monetize information. Two-thirds of financial institutions observed attempts to steal non-public market data for insider trading or shoxing, where attackers short a stock and then leak confidential data to regulators to damage the victim's share price. Let's continue with cyber matters, shifting to a broader threat that could affect more industries. Researchers at Watchtower found 150 abandoned cloud storage buckets once used by major firms and governments. By re-registering them, they received 8 million file requests in 2 months, enough to serve malicious files. Organizations worldwide still reference these forgotten repositories. A cloud storage audit can help prevent attackers from reclaiming old buckets. Now, let's pivot to a set of findings from the insurance law firm Kennedy's, which published a global survey risk ranking featuring the perspectives of more than 170 partners across 17 countries. They identified artificial intelligence, cyber attacks or outages, and extreme weather events as the top 3 concerns. However, regional differences emerged, especially in the United States, where social inflation, things like increasing litigation and expanded liability, ranked higher than in other regions. Kennedy's report also points to AI as a growing influence over the next 3 to 5 years. 17% of their partners named AI adoption their top risk, but many expect its true impact to become more pronounced in the midterm. The firm stresses that organizations must consider the accuracy, ethics, and safety of data used in AI tools, as well as potential gaps in insurance coverage that might arise from AI-driven services. Assessing whether existing cyber or professional liability policies cover unintentional AI-related errors is crucial. Now let's shift our focus on the EU AI Act, which came into effect on August 1, 2024. With some key obligations becoming applicable on February 2, 2025. This piece of legislation is setting important standards for how organizations should develop and deploy artificial intelligence across the European Union. Let's start with AI literacy requirements. Under Article 4, providers and deployers of AI systems must ensure that their employees and contractors have a sufficient level of AI literacy, taking into account prior education and the kinds of AI applications they're working with. By February 2, 2025, companies should be able to demonstrate at least a base level of AI training for relevant personnel. Although there are no direct fines yet for failing to meet AI literacy standards, regulators can raise concerns in investigations, and companies could face civil liability if untrained employees cause harm using AI. Moving on to prohibited AI practices under Article 5, several specific uses of AI will be banned from February 2, 2025. These include manipulative AI systems that exploit people's subconscious, exploitive AI that targets vulnerable groups, emotion recognition in workplaces that could breach privacy, social scoring for unfair commercial purposes, and more. The financial stakes are high. From August 2, 2026, organizations breaching these prohibitions could face fines of up to 35 million euros or 7% of global turnover, whichever is greater. Enforcement is set to be stringent, and there's no shortage of potential overlap with other legal frameworks such as the GDPR. Already, regulators in the EU have gained the power to ban AI systems deemed an unacceptable risk to society, marking the first compliance milestone of the AI Act. Companies using such banned AI applications risk steep penalties. Meanwhile, an international AI safety report has flagged the rising threat of general-purpose AI that adapts to various tasks, warning about emerging risks like AI-enabled cyberattacks or large-scale job disruption. The AI Act is not only about prohibitions. Certain systems are classed as high risk and must go through strict assessments, while other obligations, such as transparency measures, will roll out gradually through August 2028. Organizations should be particularly careful around untargeted facial recognition, predictive policing, and emotion detection, as these uses could be viewed as manipulative or infringing on fundamental rights. From an operational risk perspective, the message is clear. Document everything. Keep records of your training initiatives. Evaluate any AI system that might come under the AI Act's prohibitions, and if there's uncertainty, detail your reasoning. The EU's approach aims to foster an environment where AI is used responsibly without undermining human rights or democratic principles. Looking further afield, President Trump's new executive order on digital assets stands in contrast to previously revoked policies under the Biden administration. The directive promotes responsible growth and use of digital assets and rejects a U.S. central bank digital currency, CBDC. Trump has also mandated an interagency working group on digital asset markets, chaired by the Special Advisor for AI and Crypto, to craft a new regulatory framework. Financial institutions and crypto firms may welcome this shift, but the order doesn't remove obligations around anti-money laundering or state-level licensing. Crypto firms should maintain robust compliance with money transmission rules, while monitoring any new guidance issued by the working group. Now let's turn to key operational risk loss events reported last week. The first update is on recent banking outages affecting major UK high street banks. Lloyds Bank and Halifax, both part of Lloyds Banking Group, experienced significant service disruptions on February 3, 2025, just days after Barclays faced a major IT glitch. Hundreds of customers were left frustrated as they were unable to make or receive payments, with many struggling to access their accounts online and through mobile banking apps. The next update is on a sophisticated phishing campaign targeting Ukraine's largest bank, Private Bank. Cybersecurity researchers have uncovered a malicious operation by the financially motivated threat actor group UAC006, believed to have links to Russian hackers. The campaign, active since at least November 2024, uses advanced phishing techniques to deploy the smoke loader malware, putting private bank customers at risk of data theft and unauthorized account access. The next update is on a major cryptocurrency fraud case involving Empires X founders. A U.S. court has ordered the founders of Empires X, a fraudulent crypto investment scheme, to pay a hefty $130 million penalty for defrauding investors of at least $40 million. The Commodity Futures Trading Commission, CFTC, filed a lawsuit against the founders for violating U.S. commodity trading laws, with the court declaring them in default after they failed to respond to the charges. That concludes this week's operational risk updates. For more on these topics and additional insights, visit the RiskSpotlight Portal. If you're a subscriber, log in or go to RiskSpotlight.com to sign up for a free trial. Thanks for tuning in, and until next time, stay safe and keep those risks in check.